Hello there again. We're moving forward with the second part with binary options with crosses, and on the first part we made a distinction between crosses and majors and said that majors are the currency pairs that have the US dollar in it, because you know by now that the US dollar is the world's reserve currency, and majors and crosses are the rest of the currency pairs. Now there are crosses and crosses that travel faster and crosses that travel not that much. For example, a cross that is not traveling that much is a euro, Great Britain pound. One that is traveling really fast is euro and Australian dollar, or Great Britain pound and Japanese yen. But if you're looking, for example, at Canadian dollar and Swiss franc, rarely, or Canadian dollar and Japanese yen, rarely it is traveling really fast. Why is that important? Well, this is important in order to divide, or not to divide. This is important in order to take the option that you want to trade. Now, if you trade, I'm talking about medium to long-term expiration dates, because if you trade hourly expiration dates or 5-minute expiration dates, or I don't know, 60 seconds, then it doesn't really matter if it's a cross or if it is a major. But if you trade, having a trading plan on a longer term horizon, then this is quite important. Number 3 in here, what should be added? Number 3, well, crosses should be traded before a US dollar driven event. For example, in order to mitigate the risk, or in order to avoid the risk of being in a trade or in a pair with the US dollar in front of an important US dollar driven event, what are the US dollar driven events? Well, we are talking here about non-farm payrolls, the NFPs, or we are talking here about I don't know, the FOMC decisions, now, and so on. Why this is important? It is important because prior to these decisions, trading, as you very well know now, it is algorithmic, or high-frequency trading dominates. We are following robots now. So on the news, on a US dollar-driven event, then it doesn't make any sense to, let's say, stay long or buy call options on US dollar Swiss franc, and then buying put options on Great Britain pound US dollar, because they will move. It is like you're taking 2 trades in the same direction. So in order to avoid this overtrading, this leads to overtrading, the thing to do is to jump into crosses. I mean, if it is a dollar-driven event, the algos anyways will buy the dollar or sell the dollar based on the instructions they have prior to the event, and based on if the actual on the economic calendar it is being different by the forecasted values. So being into crosses will solve this problem, and any technical analysis that you will make and any expiration date that you will choose will not depend on the US dollar driven event. The same it is when you are trading euro pairs and the ECB is coming, and the ECB with the press conference, it means that it is a euro driven event. So avoiding euro pairs or trading crosses that do not have anything to do with the euro might be the case, like trading in that instance Australian dollar, New Zealand dollar, or trading Great Britain pound Swiss franc, or trading I don't know, Canadian dollar Swiss franc, or New Zealand dollar Japanese yen would be something to keep in mind. This is the big difference between majors and crosses. Keep in mind that crosses consolidate the most. Crosses are ranging not only on the Asian sessions, but also in the London and the North American session. Thank you for being here, and have a great day. Bye bye.